Hey. This is Dr. Barrio, your mortgage doctor, and I am here to put in the work.
Need that fire truck to come and get me. Money and water, 'cause this boy is fire, has got a hold of me.
Today, we're going to talk about avoiding bad credit scores. Lots of information out there around credit. I'm going to give you some of the true, some of the good, some of the bad, and more importantly, all of it's going to be real and it's going to apply to all of us. So let's go and get started. Your credit score. So what is a credit score? Your credit score is a numerical value that is assigned to you based on a number of financial factors. Having a lower credit score does not mean you are a bad person. Credit scores run anywhere from 400 to about 800. The higher your credit score, the more opportunities you're going to have to get better rates, better pricing, have access to different types of financial products. But having a low credit score does not make you a bad person. What the bank sees and what lenders see when you have a low credit score is that you are a high credit risk. And depending on the level of risk that you are, is going to determine on whether or not they're going to extend you more credit. So if you're very risky, and let's say your credit score is 420, 450, it's going to show that you have a number of late payments or that you don't have a history of paying bills or on time or paying them at all. So they may not want to extend you credit because they do not want to extend you credit and have you not pay because there's been a history. Now, there are two main credit scores that are used from two different companies, the FICO score and the Vantage score. Today, I'm going to primarily be talking about the FICO score. So the FICO scores, again, like I said, go from anywhere from 400 to about 800. Another thing that people don't know, I can say don't know, another important factor is that from a mortgage perspective, we look at credit scores in groups of 20. So 580 to 599, that's the same group of credit scores. So if you have a 595 and it drops to a 585, you're still in that same grouping because we do them in groups of 20, 600, then 640, 660, 680, 700, and so on and so forth. Depending on the type of program, you may max out at about 720 or 740. So if you have a 740, even if you have anywhere from a 740 up to an 800, it's still going to be the exact same amount of pricing and the same rates. So just trying to help some people calm down when it comes to stressing over credit scores, because there's more information is better in this case, which allows us to be able to make better decisions. So now, different programs have different minimal credit score requirements. And so depending on the lender, they may be able to get around some of these minimum scores or they may not. But they're different ones. And they do change as the market changes, as the environment changes. But in general, if you are a VA purchaser, you probably want to have at least a 620. If you're going to be purchasing an FHA, you can go all the way down to 580. And in some cases, you can go down to 500 if you have more money to put down. What I always recommend is if you're below 580, you have the money to put down, let's look at a way to use that money you're going to put down to get your credit scores higher, because it's going to benefit you more over time if we can get your credit score higher. So VA, you want to be around 620 and above. FHA, you want to be around 580 and above. Conventional, I've seen some conventional get approved around 640. And then there are other loan types. They call them non-QM loans, non-qualified mortgage loans. And these are loans such as bank statement loans, profit and loss loans, 1099 loans. These loans, you're going to want to have a higher credit score. So I would recommend a 660 at a minimum, definitely 680 or above. If you're self-employed and you can't use your tax returns and we have to use an alternative way of getting you a mortgage, you're going to want to have your credit score higher and actually have more cash as well. So that is how the programs look at credit scores. That's good information to keep in mind as you're trying to determine what you may or may not qualify for. So now, let's talk about what your credit score is made of and actually how to avoid bad credit or have your bad credit get better. Credit score is made up of 5 different factors. The first major component that is 35% of your credit score is your payment history. Your payment history includes how often you've paid on time, how often you've been late, how late have you been? Or have you been 30 days late, 60 days late, 90 days late? Have you had a bankruptcy? Have you had a foreclosure? Do you have collections? These are some of the major components when it comes to generating your credit score. So if you're going to look at getting your credit score better, you want to look at especially the first 2 items, the payment history. And so paying your bills on time is one of the best ways to make sure that your credit score is in a reasonable area. The second component, which comprises 30% of your credit score, is utilization. Utilization is basically how much of your available credit are you using. So if you have a credit card that has a $1,000 limit and you have used $900, you're at a 90% utilization. The higher your utilization, the more of a credit risk you look like, and therefore your credit score will be lower. I would recommend that you try to keep your utilization under 50%, preferably under 30%. I would say a little asterisk is you don't necessarily need to have it at 0. If you have a credit card at 0, some cases it actually may drop your score because your credit score is your credit risk, which is a gauge for how you manage your credit. And in some cases, if your credit card is at 0, you're not managing your credit, so you actually might lose points. So keeping a balance, $10, $100 or something, is always going to be helpful. But you want to try to keep your utilization at 30% or less if you can. The next component that is involved with the next factor that's involved with your credit score is the length of time you had credit. So if you just graduated high school, you just graduated college, you don't have any credit, it's very possible that your score will be hurt just a little because you don't have a long history of credit. The next component, which is approximately 10% of your credit score, is how much new credit you have. So all of a sudden you got a whole bunch of new credit cards that all of a sudden that could actually hurt you because you got so many brand new. So having a longer credit history and having credit trade lines, as we like to say, that have been there for a while play a 10% factor. And then the last factor is 10% of your credit score is your credit mix. What types of credit? Do you have a car loan, credit card? Now it's really interesting to note here that certain types of loans like payday loans and these short-term loans, that is a type of credit that could potentially hurt your score. So always be aware and be mindful of that before you take out any of those types of loans. Now what you will notice is that what was not mentioned is inquiries. The inquiry conversation is near and dear to my heart. Inquiries. That's when you actually have someone, you apply for a loan, and the person, as we like to say, pulls your credit. And when they pull your credit, that's an inquiry. And that inquiry is noted on your credit report. In many cases, if you do an inquiry, multiple inquiries within the same short period of time, we're going to call it same short period of time, they are counted as one inquiry. Having multiple inquiries over a longer period of time with different types of credits can impact your score. But we're talking like 15, 20, just a number of them over time in order for your credit score to be really negatively affected to keep you from getting approved for a loan. So I'm going to say this with all sincerity. In many cases, I run across people who are just stressed out and stressing everybody else out over hard inquiries versus soft inquiries on their credit. I have been doing this job for a while, and I've never had a person not get approved for a loan because of inquiries. You don't get approved because you don't pay your bill, because you lying about your bill, because you hiding money, because you're hiding debts, because you bought that car and we told you not to buy that car, because you let 3 people use your credit and you get all. That's how you end up not getting approved, not inquiries. So please, please, please give the loan officers a little break when we start talking about inquiries and the hard pulls. And what I like to say is simply this, is that if you've been keeping your credit together, the purpose of you keeping your credit together and keeping the score high is so that you can do the hard pull to get a mortgage. So if there's any one person who you should not be giving grief to about a hard inquiry, it's the loan officer who's trying to help you get a house. And in many cases, that one inquiry is not going to have so much impact to your credit. And like I said before, unless you're right on the border between 620 and 619, if you're right on the border at 580, then you may want to reconsider a hard inquiry. But we do them in groups in 20, and in most cases, the inquiry is not going to hurt your credit that much. Again, thank you so much for your time. Just remember, if you want to get your credit better, you want to keep it good, you want to get it from bad to good, you want to pay your bills on time, you want to try to keep your utilization low as possible, you want to have a nice credit history, a nice credit mix, you want to make sure that you keep your new credit to a minimum, and overall just try to pay your bills on time. Please pay your bills on time if you want that credit score higher. And remember, a low credit score doesn't mean you're a bad person. It just means the bank looks at you as a much higher risk when it comes to your credit. Thank you for your time. Again, Dr. Barrio, your mortgage doctor, putting in the work.